Welcome back. By now, you understand the core mechanics of trusts, but as your roadmap becomes more detailed, you may find that some of your assets need more specialized treatment. Today, we are looking at the special forces in the trust world. We are going to talk about irrevocable life insurance trusts, land trusts, and the honest truth about asset protection trusts. Let's start with a common and sometimes very expensive myth: the idea that life insurance proceeds are always tax-free. While it is true that your family usually won't pay income tax on the check they receive, those proceeds could still be subject to a massive estate tax hit. Why? Because of a single word: control. If you have the power to change the beneficiary, borrow against the policy, or cancel it, the government will often say you own it. That means if you have a $2 million policy, that $2 million would be added into your taxable estate when you pass away. For some families, this could turn a manageable situation into a massive tax bill they didn't see coming. This is where estate planning tools and techniques can come into play. One of these tools is the Irrevocable Life Insurance Trust, or ILIT, said ILIT. Think of an ILIT as a specialized vault designed for one thing: holding your life insurance policy so you don't own it in the eyes of the taxman. When you set up an ILIT, you are the grantor, but name someone else as trustee. You transfer the policy to the trust, and the trust becomes the owner and the beneficiary. Because you've given up control, those proceeds can flow to your loved ones free of federal estate tax. However, because the trust is irrevocable, you can't just reach in and change your mind later. There's also a bit of paperwork maintenance involved. Each year, when you give money to the trust to pay the insurance premium, the trustee must send out what is called a crummy notice. It's a simple letter to your beneficiaries letting them know a gift was made. It sounds like a hassle, but this small step is what allows those gifts to qualify for the annual gift tax exclusion, keeping your plan safe from IRS scrutiny. The concept is simple. If you don't own the policy and you don't control the policy, then the death benefit can be outside your taxable estate. So instead of you owning the life insurance policy directly, the ILIT owns it. And instead of the insurer paying your beneficiaries directly, the insurer pays the trust. Then the trust distributes or manages the funds based on rules you wrote in the trust document. This can be a large blessing for your heirs when they need cash for taxes, debts, and administration. Especially if your wealth is tied up in illiquid assets like real estate, a business, a farm, things you don't want your family forced to sell at fire sale prices just to raise cash quickly. So an ILIT can be used as a liquidity tool. Now, there are two common ways an irrevocable life insurance trust can get its insurance. Option 1, transfer an existing policy into the ILIT. Option 2, have the ILIT buy a new policy from the beginning. If you choose option 1 and transfer an existing policy, there's a big warning to know. If you die within 3 years of transferring the policy into the ILIT, the IRS may treat the proceeds as if they were still in your estate. That's often called a 3-year rule or 3-year look back. However, if the ILIT buys a brand new policy from the beginning, you generally avoid that 3-year issue because you never owned the policy in the first place. Now, how does the ILIT pay premiums? Usually through gifts. You make gifts to the trust. The trustee deposits them into a trust account, and the trustee pays the premiums. The important detail: you don't pay premiums directly. It sounds like a small thing, but the entire theme of ILIT planning is separation of ownership and control. And now, back to those crummy notices we mentioned earlier. When you gift money to the ILIT, you often want those gifts to qualify for the annual gift tax exclusion. But to qualify, the gift generally needs to be a present interest. So, many ILITs use crummy withdrawal powers, meaning beneficiaries are notified that they have a temporary right, often around 30 days, to withdraw the contribution. They usually don't withdraw. But the notice and the right to withdraw matter for tax compliance. That notice is commonly called a crummy notice or crummy letter. Here's the practical takeaway. If someone tells you, set up an ILIT and then forget about it, that's a red flag. ILITs often require ongoing administrative discipline, timely gifts, proper premium payments, and consistent notices. Now, let's shift gears to your real estate. Imagine you own a piece of property, but you don't want your name appearing in the public county records for every curious neighbor or lawsuit hunter to see. A land trust allows a bank or a trust company to be the nominal owner of the record. Your name is hidden, and you remain the beneficial owner with the power to manage, sell, or rent the property. A land trust is mainly about title and privacy, and sometimes probate avoidance in certain states, but they are not a shield from everything. A land trust does not protect you from a lawsuit if someone slips and falls on that property. It also doesn't hide the property from your own personal creditors if they already know you own it. It is a privacy curtain, not a bulletproof vest. This brings us to the bigger topic of asset protection. You may have seen ads promising that a specific trust can make you invisible to creditors or lawsuits. It is important to be very clear about what works and what doesn't. For most everyday situations, the best asset protection isn't a complex trust. It is likely umbrella liability insurance. This is a low-cost policy that sits on top of your auto and homeowner's insurance, providing millions of dollars in coverage if you are sued. In the world of planning, there's a saying, only insure what you can't afford to lose. If you have a high-risk profession or own a business, you might look at incorporation or forming an LLC to protect your personal savings from business debts. But remember, a standard revocable living trust provides almost zero protection from your own creditors during your lifetime because you still control the money. True asset protection usually requires giving up control through an irrevocable structure, which is a significant strategic decision. Here are the basics that keep people out of trouble. First, revocable trusts are not magic shields. If you can revoke it and pull assets back at will, creditors and courts usually treat it like your property. Second, asset protection is not something you turn on after the problem happens. Transfers made to dodge known creditors can be attacked as fraudulent transfers. So, I'm getting sued next month. How do I move everything into a trust? Is not planning. It's a legal disaster. Third, if someone is promising bulletproof, IRS-proof, lawsuit-proof, or guaranteed protection, be very skeptical. Real planning is about reducing risk, increasing structure, and following rules, not bypassing reality. Legitimate protection often comes from boring fundamentals like appropriate insurance coverage, good entity structure for risky assets, separation of personal and business assets, and, where appropriate, carefully drafted irrevocable trusts with the right timing and administration. So what's the big picture? ILITs are about separating ownership and control of life insurance to reduce estate tax exposure and create liquidity at the right moment, at death. Asset protection is about legitimate structure, timing, and compliance, not miracle promises. And land trusts are about real estate title handling, often privacy and probate convenience. Your action step from this lesson is simple. For each specialized asset, ask one question. What is the real goal here? Tax, liquidity, privacy, or protection? Because the right tool depends on the real goal, and when the goal is fuzzy, people end up buying the wrong tool with a very confident sales pitch.